let's understand why the prices of REITs might have crashed, and yet their business fundamentals remain solid, which will lay the foundation for how we can take advantage of that. The first thing is that REITs have been preparing for times like this for over a decade now. During the financial crisis of 2008, a lot of REITs had huge issue because of high debt compared to their assets. Think of it as the percentage your mortgage is to the value of your house. If you take an 80% mortgage, it means you have a loan-to-value ratio of 80% because your debt is 80% of the asset. A lot of management teams learned from their mistake, and REITs have been lowering their debt levels ever since. Currently, REITs on average have loan-to-value ratios of around 35%, which is very conservative. It gives them a lot of breathing room, just like you would be in a much better financial shape if the mortgage was 35, not 80% of your house. Another very important factor is that REITs have taken advantage not only of more than a decade of ultra-low interest rate environment, but also of the option to fix their debt. The majority of debt REITs nowadays use is fixed, meaning that they have been largely insulated from the rate hikes. As many of you know, when the interest rates go up, if you have a fixed rate mortgage at 3%, the rates might go to 12% and you don't care. Unless you decide to refinance, which means taking on new debt at the current level, your interest rate will stay at 3%. So basically, if a REIT has 10% of their debt maturing this year and the rates are high, this will only affect 10% of their interest expense. Investors seem to forget that and think that when rates go up immediately, all the debt of the REITs become more expensive, which is far from true. That ties in with the next reason why real estate investment trusts are in far better shape than people think: the maturity schedules. Maturity is basically when your debt is due. Ever since the financial crisis, REITs have extended their average maturities to the point where now it is over 7 years. So even during the fastest rate increase in history for them, only part of the debt needs to be refinanced at high rates. However, depending on the sector, the inflation, which was the reason for the rate hikes, affects 100% of their rent. If a REIT has built-in inflation-linked escalators, then 100% of the rents automatically go higher, while only a portion of the debt needs to be refinanced at higher rates. This is one of the reasons why actually the profits of REITs have never been higher, despite their share prices getting decimated since 2022. This is one of the reasons why I believe there is a fundamental mismatch between what the market is pricing the REITs for and what their situation actually is. As this research from Cohen and Steers points out, rising rents matter to REITs more than rising rates. And for the majority of REITs, they have been growing their cash flows and dividends ever since the rate hikes started. I remember a REIT I invested in the spring of 2023 having the absurd situation of their price getting destroyed by 30% for the past 12 months at the same time as the REIT managed to increase its rent by 30% for the exact same 12 months. So for me, this was such an absurd situation that I had to take advantage of it. This graph from REIT clearly shows that net operating income, which is, to simplify, basically the profit of the REIT, has been steadily increasing relative to their interest expenses. Why is that possible? Well, because, as I said already, and to quote again the research from Cohen and Steers, rising rents matter more than rising rates, which, to paraphrase, means that the health of the economy in general matters more to REITs than interest rates. And the USA economy has proven to be pretty resilient despite the high interest rates. Why that is beyond the scope of the video, but what is important to know is that REITs are direct beneficiaries of it. As you can see in this research of REIT, rising rates generally reflect improvement in the underlying fundamentals. Interest rates typically increase during periods when macroeconomic conditions are strengthening, the same strengthening that often drives positive REIT investment performance. Strengthening macroeconomic conditions typically lead to higher occupancy rates, stronger rent growth, rising property values, and higher dividend payments to investors. The big recession in the USA economy that everyone expected in 2022 never actually materialized, and this is one of the reasons REIT fundamentals have been so good despite their share prices getting destroyed, which, as I said, is a huge market mismatch, which we can take advantage of. When the economy is growing and businesses are expanding, the need for real estate goes up, which leads to higher occupancy rates and rents for REITs. This is one of the reasons I have chosen to pick a REIT from one of the hottest sectors of the economy as one of my top 4 stocks and ETFs report for the current environment we are in. You can get it for free by going to the link in the description. This is just a part of my thesis about how to get rich with REITs. To watch the full version, click on the video that should have appeared on your screen right now.